Okay, let's take a look at the three practice problems that we have for this first part of chapter 3. So the first one, exercise 3-2b. We have a janitorial company. They perform services for $20,000 in cash. So cash increases by $20,000. Retained earnings increases by $20,000. Then they purchase $4,000 of supplies on account. So supplies increase because it's on account. We record accounts payable, so the liability increases. Make this a little bit bigger. Okay. And then here, a physical count at December 31st, year one, found that there was $1,000 worth of supplies on hand. So I can do that math and see that that means we must have used up $3,000 worth of supplies in performing those services. So supplies goes down by 3,000, retained earnings goes down by 3,000 because I'm recognizing the expense of using up supplies. So I total things across the bottom here. I have 20,000 in cash. I have $1,000 in supplies, which equals what the problem tells us. I owe 4,000 on accounts payable, and I have a $17,000 in retained earnings. So I see both sides are at 21,000. So the income statement for that is for the year ended December 31st, year one, so the period of time that's relevant here. I had revenues of 20,000 and expenses of 3, so I had net income of 17,000 in this simplified problem. The balance sheet for this company, again, it's as of a particular date, so it's standing on December 31st, year one. What was the picture of the company? In this case, they had assets. They had cash of 20,000. They still had $1,000 worth of supplies in their supply cabinet, so they had 21,000 in assets. They had accounts payable as their only liability, $4,000. And then under stockholders' equity, they didn't have any common stock. That wasn't part of the problem. We had 17,000 of retained earnings, so liabilities and stockholders' equity total 21,000, which equals my total assets. The last part of the problem, they ask you to do a statement of cash flows, and we haven't done many of those, but this one is fairly simple. I can already see I have a mistake. So this should say for the year ended December 31st, year one, so what happened over a period of time. So cash flows from operating activities, well, I had cash receipts of $20,000. That was it. So that's 20,000. I had cash flows from investing activities, 0. Cash flows for financing activities was 0. So the net change in cash was 20,000. I started the year with $0 in cash, so I end with 20,000 in cash. So the balance in the supply account as of January 1st, year 2 is $1,000, and the balance in the expense account is at the end of year 2, as of January 1st, we would start the year with 0. We would wipe the slate clean and start with 0 at the beginning of the next year from an expense standpoint. So the next one I want to look at is 3-4b. So this is a similar problem, but instead of looking at expense as we consume things, we look at an expense as time goes by. So the first thing here, we perform services for 18,000 in cash. So cash goes up by 18,000, retained earnings goes up by 18,000. I'm recognizing revenue. The next thing, on February 1st, year one, we paid 12,000 to rent office space for the upcoming year. It's always a good idea to write down, if you're working on a problem on paper, how much that is per month. Do the math right there. That's $1,000 a month. So when I prepay my rent, cash goes down by 12,000 and prepaid rent goes up by 12,000. At the end of the year, I recognize that 11 months have elapsed. So I've got February through December has gone by. So I reduce my prepaid rent by $11,000 and recognize rent expense, which pulls down my retained earnings. I total things up. I have 6,000 in cash. I have $1,000 in prepaid rent that represents the rent I've paid in advance for next January of year 2. And I've got 7,000 in retained earnings. So both sides equal 7,000. So my income statement is going to be 18,000 in revenues, 11,000 of expenses for net income of 7,000. The balance sheet, again, that's as of a particular date. I've got assets. I've got $6,000 in cash, $1,000 of prepaid rent. That came from the bottom of my transaction grid. So I have total assets of $7,000. My liabilities were zero. This problem didn't have any liabilities. And stockholders' equity was $7,000. So liabilities plus stockholders' equity equals $7,000. So this equals this, which is good. The last thing they ask us to do is a statement of cash flows. So we had two different cash flows, and I could always look at this column here and say what happened with cash. It started at zero, and I had a couple operating activities there, and it ended at 6,000. So cash flows from operating activities, I had cash receipts of 18,000 and cash payments of 12. So the net cash flows from operating activities was 6,000. Didn't have any investing or financing activities, so the net change in cash was 6,000. My beginning balance was zero, so when I add the change to my beginning balance, I end up with 6,000. So ignoring all future events, what's the amount of rent expense that would be recognized in year two? Well, it would just be that $1,000 that I would recognize for January. So the last problem I want to show you is dealing with unearned revenue. So receiving money in advance of earning the revenue. So in this case here, on October 1st, year one, IDC collected $24,000 for consulting services it agreed to provide during the coming year. That works out to $2,000 per month. So in that case, I'm going to receive cash of $24,000 and I'm going to create that unearned revenue liability of $24,000. If immediately after getting that check and putting it in the bank, I decide, you know what, I don't have the employees to be able to do these consulting services, I don't know what I was thinking, I have to tell them we can't do it, I need to pay them that money back. So it's a liability. I owe them the money until I've earned it. So then we adjust the accounts at year end. We're assuming that we do an equal amount of work each month over the 12-month year. So at the end of year one, I take 24,000 divided by 12 and multiply by 3 for October, November, December. So I reduce my liability. If I quit at the end of the year, I would owe them back less money than what I received. And I recognize 6,000 of revenue. So across the bottom, I've got 24,000 on both sides. So the income statement, I've got 6,000 in revenue, 0 of expenses, 6,000 of net income. And I didn't do the cash flows on this one. So I've got cash of 24,000, total assets of 24. I've got a liability, that unearned revenue of 18,000. And I've got retained earnings of 6, so I've got total liabilities and stockholders' equity of 24. So this equals this, and all is right with the world. So hopefully that is helpful for you. If you have questions when you're working on your homework, please shoot me an email. Thank you.